This program is called the Tradeoff, and we talk about big financial decisions. With every big financial decision, there's something else you could have done, and that's where the trade-off lives. When it comes to divorce, trade-off is everywhere, whether it's kids, cars, houses, 401ks, making decisions about who gets what and how that's handled. These are all big trade-offs in people's lives. And today we have Jason Wright, who's an attorney practicing family law, amongst other things he can describe. And we're going to dig into these topics together. Thanks for being with us today, Jason.
Thanks for having me.
So I'm a financial advisor, of course. I've been doing this a while, and I've noticed that a lot of times in a couple, one side of the couple is really in tune with the financial situation. They know the budget, they know all the accounts, and the other often doesn't pay much attention at all. I would imagine this could be quite problematic going into a divorce situation. How do you see those things kind of play out?
Not only is that your experience, that's fairly common, and interesting enough, it doesn't necessarily have to be the party who knows everything about the finances may not be the person who makes the majority of the money. It may not be the money winner of the family. So that those two things aren't always synonymous, but that issue is very, very common. And I would say that, well, let me just back up. First of all, there's a common misconception. Most people know that Texas is what we call a community property state. And most people walking around think that simply means everything is 50-50. What I would say to you is that that's mostly true, and that there are points in the law that give us signposts to work on that. But from the date of marriage, when two people get married in Texas, they create a new legal entity. A community estate is formed. And there are all kinds of ways that money that was being earned before the marriage, or investments that were earned before the marriage or started before the marriage, can have a community property interest. The ownership of them may still be a particular party's, what we call separate property, but there may be a community property interest in that asset. And so when you have a party that knows what all the assets are and knows what all the balances are, and then you have another party who doesn't, right off the bat, we have an issue of understanding what assets we have to divide. And so one of the things that we often see is that families that are in a situation where potentially one partner makes all the money and handles all the finances, and the other partner, let's say, is, stays at home with the children or doesn't work, or, whatever the arrangement is in that marriage, the person who makes the money and knows all the things tends to have a position that it's their money, or they are the ones that are in control. And from a family law standpoint, that's just not true. And so we often find ourselves peeling back and trying to get information. So, one thing that I advise my clients, that would translate to your clients as well, is to be informed about what it is their family is invested in, or what their financial standpoint is on all of their various accounts and investments. Having some understanding of what they even are is critical, because it becomes a huge problem when one person doesn't know. If we don't even know what we don't know, trying to find that can be difficult. And there are ways around all that, but it makes it much more difficult, and it becomes a much bigger fight when we're trying to peel back things and get information from people who think that it's not the other person's, et cetera. Does that make sense?
Sure. And I think one of the reasons that happens is because married couples typically, they don't want to let the thought of divorce creep into their heads and let that affect their planning and decisions. And these things can happen abruptly, and all of a sudden people are scrambling to find information that they don't even know where to look. They won't know how to get the password. I would imagine that kind of thing is a problem.
It absolutely is a problem. And I mean, even in my own marriage, right? My wife handles a lot more of our finances than I do on our day-to-day budget. That's more just because of how we've divided labor in our own relationship. But I would say that it's important that both partners know at least what's going on, or have some way to educate themselves on what is happening, and where passwords are. Just having online access to see things is important. And when you don't have those things in your day-to-day marriage, when that marriage is falling apart, or when that family is changing, that becomes a problem. So I agree with you that most people don't like, and it's probably not the best way to have a healthy marriage, to be thinking or planning for your divorce. But if you look at it like, well, if nothing else, I want to be involved in our family's finances, or educated enough, that's a better approach, I think, and a smarter approach, especially if things do fall apart, on that end at least.
So I want to ask you a question that answer it however you're comfortable. But a lot of people talk about how expensive a divorce can be. They talk about, kind of joke about how lawyers want these things to be contentious, drag them out so they can generate the highest fees possible. Of course, that's cynical to a degree. I understand. But what can a couple realistically do to keep the fees reasonable during the process?
So there's a couple things that I always tell potential clients, and I actually end up telling my clients often after they've hired me, is, agreements are cheap, easy, and fast. I mean, and that's the honest truth. The more things that people can come to an agreement on, the faster things move, the easier it is to get to where they want to go, and frankly, the less it costs. Where people incur fees is when we disagree. And a common question people ask me is, how much is my divorce going to cost? And I tell them, anyone who is, unless they're quoting you a flat fee, which I don't know I personally don't know any colleagues in this area that do flat fee divorces, contested divorces. If they're telling you any amount, they're suspect, because no one can tell you exactly how much something's going to cost, because you can't control what the other side is going to want to fight about, or what you're going to want to fight about. And if we have to fight, there's only one decider, as I tell clients, and that's a judge. And if the parties can't come to an agreement, either through their lawyers or on their own, then we have to go to a courtroom and ask a judge to decide their fate. And that can deal with their family, or it can deal with their money, or things of that nature. But for me, I'm constantly trying to advise my clients on that principle of, cheap, easy, and fast. And I say that often to them is, anytime a position comes across, their choices are to agree or disagree. And if they agree, then we move forward. If we don't agree, then how can we, counter that? Or what, is there something about it we can agree to and try to chip away at? Because the more we fight, the more it costs. And that is truly the simple equation. And I have lots of times I will tell my clients, and I've told my wife this, and I tell my clients this, there are lots of times I counsel them in ways that is not financially advantageous for me, but it is by far financially advantageous for them, to decide something, or to look at something maybe that they are ready to fight about and just upset about, and to try to help them look at it from a different perspective, so that they can understand, would you rather spend that money fighting about it and, essentially helping my children, or do you want to find a way to agree and have that money be used for your children? I mean, that's trying to help clients understand that can be difficult. But that is an all too common issue. I would tell you too, another concept, we're all human, is that sometimes we get something in our crawl that we are ready, principle, right? I'm going to fight about the principle of this, whatever that is. And I can regale you of various principled stories that someone may come in. But what I tell them is, I'm happy to represent you and fight for you and do whatever it is that you feel you need. But principle is one of the most expensive things that I do. Fighting for principle is extremely expensive, because there is no price point that it hit. And I'll tell you this, rarely rarely when we've won on principle does the client feel that they got their money's worth. To be frank with you, once at the end of it, they may have won that thing they were fighting for and they got that principle, but ultimately when they look at it, most of them think, man, I wish I had found a way to agree early on. And that's, they're in control of that.
Yeah, there's a market value for a 401k, that's clear, but there's no market value for a principal that's
Yeah.
important.
And when you're dealing with things as primal and as personal as people's children, sometimes there is a principle that is worth fighting for, but clients have to understand. I try to make them aware as much as possible that, as I've said, without an agreement, you're going to take that to a courtroom, and principle fighting is expensive.
Let's get into the process a little bit. I'm curious, I imagine a lot of people are wondering if they get into the divorce process before before there's any settlement, both spouses have access to everything.
Mm-hmm.
What if one of the spouse clears out the bank account, buys a bunch of cryptocurrency or something?
Mm-hmm.
How is that factored into the process? And when it comes to dividing up assets, is there a timestamp where you go back in time? How do you think about that?
So, to give you the most basic legal answer is it depends. And in Travis County and in Williamson, in fact, in most surrounding counties, Travis, Hayes, Williamson, we have what we call standing orders. And what that means is whenever someone files a lawsuit, in this case a divorce, and they serve the other person with that lawsuit, the judges in this region have gotten together and said, okay, from this point, here are some rules going forward. Just basic rules such as, you can't cancel the utilities, and you can't take the children out of school and enroll them in a different county. And there's just basic guidelines to say, okay, you filed a lawsuit, don't lose your mind. But you're correct in that, and in Texas, we don't have a legal separation. You're either married or you're not. And so clients that are in the 2 years into a divorce are still married, and at any point in that process, if they wake up and decide, wait, I'm madly in love with this person, I want to make more babies with them, let's get rid of this divorce, they can, and there's nothing, we don't have to remarry them. Okay, so yeah, when you've got a situation where people are clearly adverse and they have control of these bank accounts, the phrase that we use is reasonable and necessary expenses. And so and that could be for attorney's fees. Community assets can be used to pay for reasonable and necessary attorney's fees. And so if you need to, move into a rental house, or you need to not, there are things that can be done with community money that the court will find to be reasonable. But for your example, if they drain a 401k and go buy some cryptocurrency, or go buy a speedboat or something to that nature, if it's not something we can get back in the sense of, it's not a pot of money that's been moved from this pot to this pot, but it's a thing, or it's a virtual thing, that asset can still be awarded later at the division. Or there are ways that we can account for what we call a waste claim. We can say that, that partner wasted community money, and so they get, virtual credit for that, which, it's looked at like, well, they had that asset and they've already spent it, so we're going to account for that, and then we divide the actual real stuff that we can hold and touch and see, and maybe give that to the other spouse who didn't waste it. There are, if things become egregious, if someone is being locked out of accounts, or they're taking money and spending it at nightclubs and things like that, you again can take that issue to a judge and say, Judge, they have violated these orders, or and depending on where you are in your case, there can be things you can do to bring it to a judge's attention, who can do what judges do and issue a punishment or give some sort of new order or things like that. But typically the starting point is you still have a family unit, you still have family expenses, you should operate like you would if we weren't in this process. But when somebody goes rogue and acts irresponsibly, we do have mechanisms to either rein them in or hopefully correct that. But sometimes when that asset is spent or gone or liquidated, it's gone. You're not getting it back. We just have to account for it, hopefully, somewhere on the back end.
Let's talk about the house. This is often the biggest asset. Home equity is often the biggest source of wealth for a lot of people, probably the majority of Americans. What I've seen is somebody really wants to stay in that house, and they get the house, but then maybe they can't afford it.
Mm-hmm.
Big mortgage payment. Maybe they can't qualify to get a mortgage under their name. Payments too big. They didn't take into account the cost of maintaining the house. All sorts of issues. What have you run into with that,
You're right in that is often in the majority of cases, it can be the single largest asset that we're trying to address. Unfortunately, for a lot of families, and you probably see this in your line of work, they're not as diversified in their savings and retirement as they should be. And so that one of them might have a 401k or they might have something, but that the equity in that house is kind of the big enchilada. And so the issue, well, let me just back up too. Something that a common issue we deal with is when both family member, both spouses are not on the note or the deed. And so that for us, there's two things. You got the note and the deed, and the note obviously is the agreement between the lender and who's going to pay for this house. But as I talked about earlier, the date of marriage is extremely important. And so if that house was purchased after the date of marriage, the presumption is that it's a community property asset. And if somebody, let's just say, one spouse had $50,000 in a savings account prior to marriage that they had, worked their whole life, mowing lawns and saved it, and they used that money to put a down payment on the house, but the house was purchased during the marriage, that doesn't make that house that sole spouse's house. And so there's often a misconception there. There might be, and is likely what we call a reimbursement claim or a separate property interest in that house. But the equity and all those, there's a community property asset asset that we're dividing. And so the question often becomes, what are we going to do with the house? And if one person wants the house, then they're going to have to find a way to essentially buy out the other party's interest. So if we have $400,000 in equity, because I like fat round numbers, and we agree that there's it's completely a community property interest, and so that, in theory, each party would have a claim to 50% of that equity. When we're putting all the assets on a spreadsheet, that $200,000 in equity that the one spouse is keeping by virtue of keeping the house, they've got to find a way through other assets to make that other party whole, right? They don't just get that and the other party is out of luck. And if we can't find those assets, if we don't have those assets, then we're going to have to sell the house. And because it's easy to divide cash in a pot. And so, so that's a common problem. Someone wants the house, but they can't afford the house. They can't afford to find the other equity for the other part. But even when they can, the question is, well, you're going to need to find a way to refinance that house. And so these are very common problems. And so it's important that, from my standpoint, it's important that people understand the character of that asset, meaning it's community property asset. And now here's a lawyer semantic answer too, right? If two unmarried people buy a house together and they're on the deed and the note, and then they get married, it may not be that house is a community property asset, but it's still an asset that they each have an interest in that we would divide and deal with even if they weren't married, like there's still a mechanism there. And so a cautionary tale that I would advise, if you have clients that are not married or living together or, things of that nature, if one party purchases a house solely, like if a boyfriend purchases a house and it's in his name and he is on the loan and they're not married, right? And the girlfriend is living in the boyfriend's house, and then they get married, that house does not become a community property asset. And there have been many examples of, and they're not always the girlfriend, the boyfriend or the girlfriend. There's been many examples of two people who are not married one of the parties thinking that they're have an interest in this house that they don't have, and then they end up getting married, and at the end, in that divorce, it comes out that asset we're not even talking about as far as dividing in the divorce, because it's not a community property asset. And there's a slew of other little, minor legalities that apply to that asset, but the equity, right, the potential major equity in that house is not a community property asset. And these are very common problems that we see. And, this goes back to, I think, our first discussion point of knowing and understanding what assets you have in your portfolio, or, if you will, your family portfolio. And if you're not on the deed, being on the deed is certainly a benefit and certainly helps us. But, the purchase date is a big point for us. When was that house purchased? And then we deal with that. But when you think about when people get divorced and the house comes up, what people don't often think about is, okay, let's just say I can buy out their equity and things that, and okay, I've got the house. Well, now what? You may not be able to afford to maintain that house. And so, is it better for you to keep the house, or is it better to sell the house and be done with it? Those are things we struggle with.
Speaking of selling the house, a married couple has a $500,000 exclusion for capital gains. And a lot of houses around Austin, Texas have appreciated a lot. So $500,000, that's a big gain to not have taxes on. But after the divorce, each person now only has a $250,000 exclusion on the capital gain. So that could end up, if they have to end up selling the house after the divorce, that could result in a big taxation that may not have been accounted for.
Right, and I don't
existed.
Absolutely, and I'll tell you, and I say that to my client, I don't practice tax law and I don't give any kind of tax advice, but that is absolutely something that we talk to clients about and explain. There are potential risks just outside of this particular thing, this asset that you're wanting to divide and or keep or sell, and you need to talk to you need to go find an expert who deals with this so that you're educated on what are the implications on my taxes, gains, all of those things, because that's going to help you make a better decision. What you thought you wanted to do in your divorce proceeding may change based on the information that you now have. That's going to, 6 months after your divorce, are you prepared to take that hit, or can you? All those things. Absolutely.
I would imagine you're often comparing two unlike assets. So you could have a bank account and a 401k. Mm-hmm. And they could be the same value, but if somebody needs income from the 401k and they're 45 years old, that income, whatever you're pulling out of the 401k is totally taxable, and there might be a penalty associated with it.
Yeah,
I guess you run into that.
We do run into that, and we have what we call quadros, qualified domestic relations orders, that allow us to split assets and create things without penalties, which is great in the immediate short term for having it, but for liquidating it doesn't change that, the penalties associated with it. And so we do try to, unfortunately, what happens is, your life as a married couple is reduced to numbers on a spreadsheet when it comes to the property division. And so what we try very hard to do is account for some of those things. Like, for instance, if we know that we're going to sell the house, well, we can't just use the market value of the house. We have to account for closing costs and things like that. So we reduce that number, knowing that, okay, that's a more accurate way to account for what the money that we're dividing in. We try to do that a little bit with 401ks and other things that might have a penalty associated with it. But I'll tell you that it's difficult, because it goes back to that principle I talked about agreement, right? And so that requires both parties to agree that if, for instance, this person's getting this 401k and this other person's getting a bank account, well, the person getting the 401k wants to account for any potential penalties if they liquidate it. The person not taking the 401k is often not inclined to agree with that, because they may not, that person may or may not liquidate it. And so if I give you if I agree that, okay, let's reduce the value of that 401k, because if you liquidate and they don't liquidate it, then that other person feels as if they have, left money on the table, if you will. I mean, that's a common fight that we talk about. And that goes back to the initial push and shove and give and get of how much do you want to fight about something. You want to pay my hourly rate to fight about something. And I will tell you, I have had people fight. They have spent my hourly rate fighting about it. And I'm not kidding you. $25 gift certificates to the Olive Garden and Cheesecake Factory. So I'm happy to help them fight and do whatever it is they need to do to feel like they're satisfied and that they've accomplished what they need to accomplish. But I do point out the math to them many times that, in the hour it's taken you to have me argue about these gift certificates, you could have purchased these gift certificates for yourself. And again, principle is a funny thing and it's expensive, but when it comes to accounting for what I'll say, potential future penalties, right? Like liquidating a 401k or anything, there is often pushback because of the, again, you're dealing with a family now that is breaking up. Trust is at a premium. These are obviously people that don't see the best in the other person right now. And so the idea that, that person's going to actually liquidate it, it's sometimes difficult for the other person to agree to, because they think, oh, I'm going to give them that account for that, and then they're not going to liquidate it, and then I've had to pay more, or I got less, that kind of stuff.
So we talked about accounting for future taxes and penalties. How about the opposite? How about accounting for future potential gains? I'll give you a couple examples. Stock options, for example, maybe today they're worth zero if you cash them out. But if you're at a tech startup that has tremendous potential, it could be worth a ton. Mm-hmm. So that's probably the most obvious example of that.
Well, not only that, but we have examples. We have lots of tech industry here, right? So we have people that work for Apple, and as part of their compensation, get shares of Apple and been staggering, and they vet at different times and all of those things. Well, there's a calculation. There is a way we can account for the marital property aspect, the community property aspect of it. So you were an employee of Apple and you were getting stocks before you met this person, during the time you met, and then you got married, and you still continue to get. So there might be just staggered chunks of, well, this thing that is vetting today, the month after you got married, it's vetting, but you acquired it 4 years ago, things of that nature. And so depending on how long the marriage was, what stocks there are, there's a vetting schedule. And so we will account for, there is a way to account for that person's percentage, community property interest in that percentage. And it, when was it acquired and when will it vet, from the date of divorce, there will be a larger or smaller share of that. But we absolutely account for that. And I'll tell you again, that's a pressure point for people who are thinking, let me just say, if I don't think I've said this before, like the F word in family law is fair. We don't use that word. I tell my clients all the time, stop using that word. There's no such thing. Because people will say that it feels unfair to them that they have these stock options that they've earned during marriage, but are going to vet years after a divorce, and that this person they're divorcing still has a claim to them or some percentage of them. And that is absolutely true. Now, I'll say that what we try to do is, I'm a proponent of finding the least amount or the fewest amount of points of contact with them post-divorce. There's a reason that these people aren't able to stay together. If we have children, they're going to have points of contact, but it'd be best if we could find ways to divide those assets and account for that, and then be able to move forward. Because when you have a scenario where, 3, 4, 6 years later, that other spouse is expecting or waiting for something. Another point is the military retirement things, pensions. We have actuaries and all kinds of things that we use. We have state and, federal pensions. Same thing, that spouse who wasn't the pension employee has a interest in that pension and will get paid out when the other person gets paid out and things of that nature. And so, very common to see.
Jason, I've got a new respect for the complexity of your work. Oh my goodness. Here's my last question. If somebody's watching this, listening to this, and they're thinking a divorce might be in their future, it is a very intimidating thought to contact a law office and get that process started. What can that person expect? What should they expect that initial engagement to be like, just to help them know what they're getting into with that just very first contact?
Well, what I'll tell you, so I do charge a consultation fee. My consultation fee is $200, but I don't really watch a clock. I would say that on average, my consultations range between an hour and a half to 2 hours. For me, what I try to do is just listen to, well, why are we here? That'll often be one of the questions I ask them, like, what brought you to my office? And that answer is extremely complex and can often, the starting point goes back years. And it may not even, but for me, it's important to listen to what has brought you here. Was it there was a thing that happened 6 months ago, a week ago, or has it been this buildup? Who knows what? But I think that and let me just say this too, I have sat where my clients have sat before. And I think that my personal experience and my personal perspective helps me give them some level of counsel. I went to law school later in life for a variety of reasons, but one of which was my personal experience going through the family law system. So I hope to give that little bit of empathy to clients, because I understand that it's daunting, but the most important thing is to just tell me, what is going on, because depending on what you're saying, you don't even know what that might be touching on from a family law perspective. And, we're talking about a financial aspect of a divorce. The other side of divorce is if you have children, you have kid issues and you have money issues. And the money issues can get just as complex and nasty, if you will, as the kid issues. But I will say that more often than not, the thing that holds people back from coming into my office is the kid issues, is thinking and fearful about what is going to change. And what I would say to you, any of your clients or anyone who's thinking about it is not going to hurt you to sit down and have someone explain to you how the law sees things, because the law doesn't always see things in the most human way, right? The law doesn't have feelings, and so educate, just like with your clients in just your normal work, right? You spend a lot of time educating them so that they can understand their financial world better. In my consultations, what I want to do is educate people on here's how the family law works. Here's how the system and the process will work depending on your particular facts and or desires. And now you're in a better position to decide, frankly, right? Things that you thought were true may not be true. Things that you thought would happen may not happen, or vice versa. Things that you thought could never be the case may be the case. And so having that understanding is critical. And I would say that whatever fear or whatever angst you have, look at it like you're educating. If nothing else, you're sitting down with someone who is an expert in that field of work who can give you information you don't have. And that information may scare you so straight you run to marriage counseling and decide, I'll do whatever it takes to fix this problem. Or it may do the opposite of make you feel, oh, well, now I understand, I have information, and I do or do not want to move forward with this.
Jason, thanks so much for the education, the insight today. How can people get a hold of you?
You bet. Thanks so much, Kevin. You can reach me. My website is jasonwrightlaw.com, and that's Wright with a W, so W-R-I-G-H-T. And my email address is jason@jasonwrightlaw.com. And you can reach me there. You can also call me 512-884-1221. And if I'm here, I'm going to pick up the phone. And if not, we'll schedule a consultation and we'll figure out what we need to do.
Jason, thanks so much.
Appreciate your time. Thank you.